Tal Hui, MD Chief Market Strategist Asia at JPMorgan as well joins in. Tal, hi, morning. October has seen emerging markets outperforming DMs. Do you expect this trend to continue till year end?
Well, I think if you look at the developed markets, there's certain earnings momentum supporting the performance. But meanwhile, I think a lot of the rebound in emerging markets is frankly due to the very sharp correction that we saw during the summer. So in that sense, it's a very different type of rally in developed markets and emerging markets. I still think that developed markets, at least for the next 3 to 6 months, will get a little bit more of a support from earnings as well as valuation re-rating. But meanwhile, I think for emerging markets, we do need to see more support from both the export fronts, which you're starting to see, but at the same time, some degree of currency stabilization, especially for current account deficit countries.
Do you expect investors to be positive on emerging markets despite internal issues which are struggling them? And do you think in the medium term fund flows to emerging markets will continue?
Well, I do think for the emerging markets, investors should be selective in looking for opportunities in these economies. If you look at the third quarter performance, you do have some of the strong performance like Korea, like China, who've actually posted double-digit return in US dollar terms. And at the other end of the spectrum, you have ASEAN and India, who've actually posted negative return. So I think for the rest of this year, as well as for 2014, differentiation amongst emerging markets is going to be critical. There are three criteria I'll be looking towards. First of all, I'll be looking at currency outlook. Secondly, I'll be looking at valuations. And thirdly, I'll be looking at the connection between individual emerging markets with developed economies such as the US and Europe, because I do expect the US and European economies to gradually recover in 2014.
Tal, for countries like India, could it be more domestic factors or global that are likely to set the course for the market movement? Is the worst over for India for now?
Well, I think domestic and global issues will interchange to influence the market at different point in time. So, for example, at the moment, the expectation of tapering by the Federal Reserve is obviously significantly reduced after the September delay. I think at this point in time, domestic factors are taking a more influential role in driving the Indian market. But as and when the Fed comes back and starts to really signal their intention to reduce asset purchase or quantitative easing, I think that will again become the overriding factor. So it really depends on which moment in time that domestic factors and international factors play a more important role. I do think that for India, at least for the next 3 to 6 months, the positive factors may be somewhat lacking, because if you look at the economy, economic momentum continues to be somewhat slow. Meanwhile, obviously, we have some political uncertainties with the elections coming up next year. So I do think that while we may have seen quite an impressive rebound in the Indian market in the past month or so, then we could still see some volatility as we approach the end of the year, as well as for the first quarter of 2014.
So what are you expecting to hear from the forthcoming FOMC meeting? Do you think the US Fed is likely to remain dovish?
I do think that between now and the end of the year, the Fed will remain dovish for a number of reasons. First of all, if you look at the economic data coming out from the US, I think, well, first of all, some of them have been delayed because of the government shutdown. But at the same time, I think many of the data that come out in for October and November is likely to reflect on some of the temporary impact of the US government shutdown, as well as the debt ceiling uncertainties. So that will actually keep the Fed where they are. In that sense, the Fed will probably be likely to maintain their current asset purchase for the rest of this year. We will probably expect to see some positive data coming out at the early part of 2014, and that should start to add to reasons for the Fed to reconsider the implementation of tapering or reduction in asset purchase.
So what about the Indian Central Bank? I mean, does it have any option but to hike rates considering inflation continues to be sticky?
Well, I do think that it does make sense for the central bank to continue to look to hike rates, not so much because not only of inflation, some of that I do see that as transitory, especially in food prices, but more importantly, as the tapering discussion is very likely to return in the next 3 to 6 months, I think the central bank is given really a second opportunity to prepare the economy and prepare the market for potential volatility that we could see coming out from the US. So in that sense, I think it does make sense for the central bank to raise interest rates, really just to prep the market for potential currency movements in coming months. But at the same time, I do think that it does make sense also to start to look after growth, because at the end of the day, with growth where we are, we probably will need to some policies to start supporting economic growth.
Most experts believe that India will push reforms on a back burner as election are now the big lurking fear, or the big factor which most of the policy watchers will focus on. Is that a big concern?
I think that's something that worries me, but it's just a reality of political cycle in India as well as any other country. So, as you run towards an election, typically difficult decisions and reforms are postponed. And again, this is not unique in India's case. So in that sense, I think markets are very much already adapted to this view. And I think market will be looking forward to a bit more political clarity either before the election or after the election results are out. And typically, this should be a positive factor to the market as we get more clarification on the political outlook of the country.
So what assumptions are you making for growth in broad macros in India for 2014?
Well, I think growth in 2014 will rebound to some extent. After a quite disappointing 2014, we could see growth returning to 4.5% to 5.5%. Obviously, not fantastic growth, but certainly a cyclical rebound compared to what we have experienced in the past 9 to 12 months. I think the external environment will be somewhat more constructive. That should help to support at least part of the investment drive by companies. But at the same time, I do expect a stabilization in consumption and investment domestically that should help to contribute to a more constructive growth outlook.
Is the trade for 2014 shifting from defensives to commodities to cyclicals? Do you think that trade will be the big one for 2014?
Well, I do think that cyclicals are likely to outperform in 2014, whether you're looking at domestic or globally. That's frankly as a result of the global recovery. I do expect growth to moderately pick up in 2014. And of course, the normalization of policies by the Federal Reserve will also benefit cyclical companies. So in that sense, I don't think it's only applicable to India, but also to the global environment. But I do think that I'm not as confident on commodities simply because the growth in China, the growth in emerging markets will only recover modestly, which means that the demand for commodities is likely to recover only modestly. So that should really cap the upside to commodity prices over the course of the next 12 months.
Ted, this year is turning out to be a write-off for India, as in dollar terms, India is the weakest market. Does that, sort of put stable rupee plus steady policy environment call for a compelling buy on India right now?
Well, I think in the near term, I'm still a little bit conservative on India, partly because if the Fed is going to implement tapering sometime in the first quarter of next year, we may still see some volatility in the rupee, so that we need to bear that in mind. And meanwhile, we've yet to see a very convincing rebound of the economy. So I think one of the very positive factors I see in India is that both the rupee and also the equity remains very attractively valued. That is a good thing, but that on its own is unlikely to create a sustainable rally. So in that sense, what I would like to see is very much a rebound of the economy and subsequently a rebound in earnings, and that combined with valuations, it could be a very potent mix to facilitate a market rally. But I think in the near term, that may not happen. It might probably take place later on in 2014.
Right, Ty, great to have you on ET Now, and thank you for joining us, and we certainly look forward to see more of you going forward.